Now, so we discussed all the major types of budget. Now, last is the cash budget. This cash budget requires some special attention. Why? Because it is often said that cash is like a, cash flow is like a blood flow of a company. I can make lot of plan about the sales. I can make sales forecast. I can make production budgets, material budget, labor budget, overhead budget, etc. But every budget will fail if I don't have adequate cash flow. Now, cash flow means what? What I mean by cash flow is the availability of right amount of cash at the right point of time. Here, the timing is very important. If I have to pay salary to my employees on first of every month, then I must have adequate cash balance in my bank account to pay. If I don't have cash, right, and the payment is due, right, that can create a huge lot of, disaster, right, disastrous effect in the company functioning and company performance. So, for a company, the management of cash in a proper way is very, very important. So, when I'm saying that it is a cash management is important, we're not talking about only the cash shortage. Even if the company is having a cash surplus, right, which is more than what is necessary, more than what is required, that is also can become very, very, very bad effect on the company's health. So, surplus cash means it may indicate that the lack of avenue for further investment, that the cash is not generating enough return. If the cash is kept in current account, that means it is not generating any return at all. So, the company at any point of time, he needs to ensure that the company should have right amount of supply of cash at the right point of time. So, what is the cash budget? So, to ensure that the company should not face any cash shortage at any point of time. At the same time, there should not be, cash surplus which is more than the desirable limit. So, we prepare a cash budget. So, what is a cash budget? The cash budget is a sketch of the business estimated cash inflows and outflows over a specific period of time. It is one of the most important, as I said, it is one of the most important and one of the last to be prepared, right? Because ultimately, how much cash I will need, it all depends upon my sales target, my production target, and all these things, right? So, it is the last one, but one of the most important budget. It is a detailed projection of cash receipts from all sources and cash payments for all purposes and the resultant cash balance during the budget. It is a mechanism for controlling and coordinating the fiscal side of business to ensure solvency and provides the basis for forecasting and financing required to cover up any deficiency in cash. It thus plays a vital role in the financing management of a business undertaken. So, it assists the management in maintaining the liquidity. The right word here is the maintaining the liquidity. Liquidity means the company must have adequate cash to repay all the liabilities at the right point of time. There should not be any default, right? Because a default in payment, it can create lot of heartburn, lot of mismanagement, and the brand value of the company may also get impacted because of this. If the company doesn't pay salary on time, doesn't pay to the creditors on time, it can create lot of issues, right, including litigation in the longer run, which is not good for the company. So, every company gives a lot of importance in preparing the in making the cash budget as far as flawless, right? And also, on the other hand, the cash budget tells us that if at any point of time there is a possibility of shortfall, if there is a possibility of shortfall, then the company needs to think of that from where the shortfall will be met. Should the company go for any short term loan, right? short-term working capital loan, or is there any other source? Is there any cash reserve available with the company? Should the company liquidate any of its investments for generating cash? So all these, key decisions, they only will trigger if the cash budget is prepared properly. So lot of emphasis, lot of importance, lot of time and energy is being devoted for preparation of the cash budget. It is one of the most important budget and it is prepared at the end. So what are the functions of cash budget? It makes sure that enough cash is available when it is required. So as I said, it is the right amount of cash at the right point of time which is required. It designates cash excesses and shortages so that steps may be taken in time to invest any excess cash or to borrow funds. If there is a shortage, company can talk to the banks or lenders for borrowing, or it can sell investments, right? If there is a surplus cash, company can think of some investment, where to invest. So that is also there. It shows whether capital expenditure could be financed internally. It provides fund for standard growth. It provides a sound basis to manage cash position. So these are the function of cash budget. What are the advantages of cash budget? Number one, usage of cash, right? The management can plan out how to use the cash, right, in accordance with the trained in receipt and payment, right? In some, say for example, in a company, in an industry which is cyclical in nature, right? Like for example, ice cream industry, a company which produces ice creams. So ice creams are usually sold in the summer. So in the summer, their cash inflow may be higher, right? At the same time, the production is also high. So cash outflow will also be higher. But in the winter, the ice cream sale usually falls, right? It is a seasonal kind of business. So at that time, the sales cash inflow from sales, it may get reduced. The production level also gets reduced, right? So company can plan accordingly. So it will, in the summer, may need more cash, more working capital. So it may need to borrow. So it can negotiate, it can talk to the banks and other lenders adequately, with substantially in advance, right? This makes the functioning of the business much more smoother. If in the summer, when the sales demand is very high and there is no cash, so it may impact the production and ultimately the profitability of the company. So this is a very, very crucial function. Allocation of capital investment. Now, if the company is cash rich, right, and if it is planning for capital expenditure, enhancement in production and etc. So what it can do is, it can do it internally, right, without going for external funding. Provision for excess funds. So one aspect is shortage of cash. There is another aspect is, there may be excess cash. Excess cash is also, the company needs to think of that how to generate maximum return out of the surplus cash, because ultimately the company management is answerable to its investors, right? It is investors' money. So if a substantial part of fund is not generating any return, right, that means the return to the investors will also fall, right, which is not desirable, because if the return to the investors, if the investors get less return, next time when the company will ask for fund, they may hesitate in providing fund. So the surplus cash, if the company is having surplus cash, how to utilize that, how to utilize, company needs to take a call on that, whether they should go for expanded capacity, buying new machines and all, or should they return back. That is also another option. They can return back this cash as dividend to the owners, right? Many companies does that also. But company needs to know that what is the forthcoming situation. For that purpose, the preparation of cash budget is highly useful too. Payout policy, as I said, that it can, if there is no investment avenue, they can give it back to the investors as cash dividend, right? Provision for acquiring funds, right? profitable use of cash. If the company has some ideas about investments, they can invest it for generating profits. Anyways, the underlying issue is, what is I'm trying to say is that if the company has some perception, right, some perceived notion that how much cash the company is going to generate, right, whether there will be any possibility of cash shortage at any point of time or extra cash surplus at any point of time, if they think like that, right, if there is a possibility, then it is always good to prepare a cash budget and refer to that. That gives management a early indication that what is coming now, and they can prepare for it. Limitations, what are the limitations? There are certain limitations. First one is, budget is a futuristic, right, exercise. It is a plan. So, it involves a lot of assumptions, because nobody is sure what is going to happen in future. So, there are lots of assumptions involved, right? And budget, as it is futuristic, so there must be always some amount of flexibility to be kept in the system, right? Because my expectation and the actual outcome may never meet, right? But within a limit, within a sustainable limit, we should keep some amount of flexibility in that. And this entire exercise of budgeting, right, which is a futuristic plan, it is costly. It involves certain expenditure, time, energy and resources, for the simple reason that all the important departments of a company should get involved into this process, right, and go through this entire process to make it successful. In fact, all stakeholders should play a role in this, because it is a complex exercise. It is not something which I already know. I am trying to perceive what is going to happen in future. So, it should go through a long drawn process that involves substantial resources, deployment of substantial resources. But ultimately, usually, if done properly, the budget is a very, very effective way of control, right, and benchmarking the performance. So, this is the utility of the budgeting process. There are several methods of construction of cash budget, right? There are several methods of construction of cash budget, and some of them are quite popular. One of the most popular method is through the receipts and payment method. Receipt and payment means I created a structure. Usually, it is made monthly, right, for a year, and every month I detail all the expected receipts and I write down all the expected payments, and I take I deduct the payments from the receipts. Whatever is left, that is my closing balance. This month's closing balance is the opening balance of the next month, and again I add all the receipts and deduct all the payments. I get the closing balance. It becomes the opening balance for the next month, and this process goes on continuously month after month, right? So, this is one of the most popular way or method of preparation of cash budget. But the issue is that in this case, the success of this method is dependent upon that how clearly I can foresee my receipts and payments in the forthcoming months. So, it is the most popular and is universally used for preparing cash budget. The assumption of statistical data is arrived at calculated on the basis of requirements like monthly, weekly or fortnightly. On account of elasticity, this method is used in forecasting cash at different time periods. So, what are the major items is this? Cash receipt from customer, and you remember this cash budget is prepared on cash basis, right? It is unlike the profit and loss account, right? Unlike the profit and loss account or income and expenditure account, the basis for preparation of cash budget is receipt and payment of cash, right? it is not prepared on accrual basis, it is prepared on cash basis. So, first I note down the receipts. So, what could be the major source of receipt? Of course, money receipt from the debtors, the cash received from debtors. So, first I write cash receipt from debtors. Then if there is any cash sales, that also comes under the receipt part, right? If there is any cash receipt from other sources apart from sales, right, like for example, getting dividends, getting interest on investments, etc., or rent received, that also comes on the receipt side, right? Once the receipt side is recorded, then I deduct all the payments, right? What could be the major payments? The cash payments. The cash payments could be for the purchase of material, cash payment as a salary or wage of laborers, cash payment for paying the direct expenses, cash paying for indirect expenses like electricity bill, rent for the factory shed, etc. So, I list down all of them, right? We will see a problem later on, right? So, I'm trying to give you the idea. So, we list down all the receipts, I list down all the payments, I deduct the payments from the receipts, I get the net cash surplus. If the receipts in a particular month, if I am doing month by month, in a particular month, if the total receipt is more than the total payment, then I will get cash surplus. In a particular month, if the cash payments are more, then my cash receipts, I will get cash deficit, right? One important thing here is I must tell you that in cash budget we include both receipts and payments of capital nature and revenue nature. Like for example, if the company purchased any machine, right, by paying cash, that should be mentioned in the cash budget under the payment side. If the company is planning to sell any capital asset during any month, right, and expecting a cash receipt, that should include in the receipt side. So, both the payments and receipts for the nature revenue and capital, they should be included in the cash budget under the receipts and payments method. Okay, right. And whatever deficit or surplus I will get at the end of the month, that will become the opening receipt and payment at the beginning of the month. Okay. This is the most popular method, which is called receipt and payment method. The second method is adjusted profit and loss account. So, adjusted profit and loss account is, we start from the profit. You know that profit and loss account is prepared on accrual basis, right? It is not prepared on cash basis, it is prepared on accrual basis. But we can start with the net income, which is shown in the profit and loss account. And in that, I can adjust the non-cash incomes and non-cash expenditures, right? If I, with the net profit, which is shown in the profit and loss account, if I add net income, right, if I add non-cash expenditures and deduct all the non-cash incomes, I can arrive at the cash flow. So, this method is based on cash and non-cash transactions. This method estimates closing cash balance by converting profit into cash. The hypothesis of this method is that the earning of profit brings equal amount of cash into the business. The net profit shown by profit and loss account does not signify the actual cash flow. That is true, because the profit and loss account is been prepared, as you may be aware, right, that it is prepared on accrual basis, right? And here the cash budget we are preparing on cash basis. So, the net profit which is shown in the profit and loss account, that doesn't reflect the cash profit, that reflects the profit which is calculated on accrual basis, right? So, signify that, that we need to convert while preparing the cash flow. Third method, which is budgeted balance sheet method. It is similar to adjusted profit and loss account method only, except that in this method a balance sheet is projected, and in that method the profit and loss account is adjusted. So, in this method balance sheet is prepared with the projected amount of all assets and liabilities except cash, right. Now, in budgeted balance sheet method, what happens? I have an idea that how much sales can happen. I have an idea that how much expenditures I am going to make, right. Now, what happened? I prepare one profit and loss account, and from there I prepared one estimated balance sheet. In the estimated balance sheet, I filled up the figures for the fixed assets, I filled up figures for the capital, I filled up the figures, estimated figures of all the other items of current assets and liabilities except the cash, right. So, after I filled up all the other places except cash, the balancing figure which I will get, that will be my expected cash balance, right. So, that is an idea. That is these two methods, adjusted profit and loss account and budgeted balance sheet method, these are basically the kind of indirect kind of method for preparing cash budget. But as I said earlier, the receipt and payment method is more direct and is the most popular method for understanding the future cash needs. There is another method which is also there, which is called working capital differential method. It is based on the estimate of working capital. It begins with the operating working capital and is added to or deducted from any change made in the current assets except cash and current liabilities. At the end of the budget period, balance shows the real cash balance. The method is quite similar to the balance sheet method. So, this is another method. Again, it is an indirect method, right. In working capital, working capital is difference between current asset and current liability. So, if you estimate, right, all the other values except cash in current asset and current liabilities, then the balancing figure will be your cash. But yes, it is an indirect method which is being used, right. Now, here is one model of cash budget which is given here. You see, it starts with the opening balance. It starts with the opening balance here, and all the receipts are added here, right. So, first receipt is cash sales, receipt from debtors, interest and dividend, sale of fixed assets, sale of investments, bank loan, issue shares and debenture and others. So, if I add, I will get total receipt. Then I deduct the payments, right. So, important payment in cash is cash purchase, payment to creditors, salaries, administrative expense, selling expense, dividend payable, purchase of fixed asset. As I said, both capital expenditure and revenue expenditure, both will come here. Repayment of loans, payment of taxes. If you add all this, you will get total payments. So, A minus B is the closing balance. So, we can do it, the normal practice is doing it month by month. So, I can calculate the closing balance for January here, right, and this will be the opening balance of February, right, and then again I will calculate the closing balance of February here, and it will become the opening balance of March. So, this can continue, this is a continuous process and it can go month after month like this. I can also differentiate, right, on the basis of whether it is fixed or flexible, right. So, I can also, so till now we discussed the budget on the basis of functions, right, sales budget, production budget, material budget, labor budget, overhead budget, production budget, then sales and distribution cost budget. So, like this, right, on the basis of functions. Now, we are classifying it on the basis that whether they are fixed or flexible. Out of these two types, the flexible budget is actually more popular. It gives you more insight about the future. So, what is a fixed budget? A fixed budget is prepared for one level of output. So, here when I am preparing the budget, I am considering that my output level will remain same, right? 10,000 units per month, 20,000 units per month. But in practice, it doesn't happen like that. I may plan for 10,000 units per month, but my actual production may be 11,000, it may be 9,000, I don't know. A fixed budget is prepared for one level of output and one set of condition. This is a budget in which targets are tightly fixed. It is known as the static budget. It is firm and prepared with the assumption that there will be no change in the budgeted level of motion. Thus, it does not provide room for any modification, so it is quite rigid. And activity. Fixed budgets are prepared well in advance. Why it is of limited use? The reason is the conditions go on the changing and cannot be expected to be firm. The management will not be in a position to assess the performance of different heads on the basis of budgets prepared by them, because to the budgeted level of activity. It is hardly of any use as a mechanism of budgetary control, because it doesn't make any difference between fixed, semi-variable and variable costs. And particularly, it is not actually, it doesn't have any room for any flexibility, any change. And we know that it is futuristic. In future, what will happen, we don't know. So, ideally, there should be some room for flexibility, right? So, in that sense, it is not very popular, particularly when the scenario is quite dynamic. Apart from fixed budget, there is another kind of budget which is called the flexible budget. In flexible budget, budget is prepared at different production levels, right? So, if my target is 10,000 units per month, I want to know that what will be my budget if my production level becomes 8,000, or what should happen if the production level increases to 12,000. So, it gives a kind of flexibility. So, this is a dynamic budget, right? It is the one which is designed to change in relation to the level of activity attained. If my activity increases, then it gives me an idea that how the budget will look. If the activity reduces, then also it gives an idea that how the budget will look. And equally accurate use of flexible budget is for purpose of control. It is again, budget is a control tool. So, flexible budget is also a kind of a control tool. So, where it is most useful, under which conditions it can be most useful, where the level of activity varies from period to period, right? If the period, this is quite normal that the level of activity is not a static thing. Sometimes it increases, sometimes it comes down. So, where it is varies, it gives the situation insight under every scenarios. Where the business is new and as such it is difficult to forecast the demand, where the organization is suffering from the shortage of any factor of production, say material, labor, etc., where the nature of business is such that the sales go on changing, right? Where the changes in fashion or trend affects the production of sales, where the organization introduces new products or changes the patterns and designs to its products frequently, where the large part of output is intended for export. So, under such basically, it is useful where the company is not certain that what would be the actual activity level the company will attain in the forthcoming period, right? So, the company doesn't know the activity level in the next 12 months, the activity level may increase, the activity level may remain at the same level, or it may decrease, the company doesn't know. So, it is important to have an understanding of all the scenarios, right? It is basically building scenarios, right? It is about building the scenarios. So, where the flexible budget is used, in flexible budgets, numbers are adjustable to any given set of operating conditions. It is therefore more sensible than a fixed budget, which is true only in one set of operating environment. Flexible budgets are also useful from the viewpoint of control. Actual performance of an executive should be compared with what he should have achieved in the actual circumstances and not with what he should have achieved under the quite different circumstances. So, at last, the flexible budgets are more realistic, practical and useful. This is actually the key word here, that why flexible budgets are so popular. The reason is that it is more realistic. It is closer to the reality, right? It is futuristic, so nobody knows what lies in future. We can only anticipate, we can only perceive, and for there, it gives all kinds of options, it gives all kinds of situations, right? It describes all kinds of situations, right? So, that is why the flexible budgets are more popular than the fixed budgets. Now, how to prepare the flexible budget? The preparation of flexible budget requires the analysis of total cost into fixed and variable components. So, in flexible budget, as we discussed, that we prepare the budget at different activity levels, and we already discussed, if you remember, right, in CVP analysis, that we can segregate the cost into variable, fixed and maybe semi-variable. So, variable costs, they fluctuate, right? They vary with the level of production, and the fixed costs, they remain stagnant, right? They remain fixed at a given production range, right? So, this while preparing the flexible budget, we need to give a consideration to the cost behavior, because when we will change the level of activity, my variable cost will also change. So, the preparation of a flexible budget requires the analysis of total cost into fixed and variable components. This analysis, of course, is not unusual to the flexible budgeting. So, it is prepared for a range of activity instead of a single level, and it is dynamic in nature, right? It is very, very dynamic. So, the formulation of the fixed budget begins with analyzing the overhead into fixed and variable cost and determining, so the costs which are already variable, right? The costs which are already variable, those costs we can simply, change with the level of activity. The costs which are completely, fully fixed, we can keep it same. But the costs which are changing with the level of activity, but not proportionately, right? That means they are semi-variable. So, in such a case, we need to find out first that out of this semi-variable cost, which part is variable and which part is fixed, right? That is the first thing we do. So, that is what we can do it like this, like this is fixed, right? So, the formulation of flexible budget begins with analyzing the overhead into fixed and variable cost and determining the extent to which the variable cost will vary within the normal range of activity. Okay. So, flexible budget, fixed 5,000, variable is 0, semi-variable is suppose 500 and total is 5,500, and it is y is equal to, if we assume that the change is happening in the straight line, so my equation is y is equal to a plus bx, right. So, here the x is, it is 0, right, and in case of variable it is 2.5x and semi-variable it is 1x, so total it is 3.5x, right. There are two methods for preparing such a budget. One is formula method and or ratio method, and second is multi-activity method. In the formula method, what we do, right, it is also called budget cost allowance method. What we do is, the budget should be prepared before the period begins, budget for the normal level of activity. So, we have an idea that we should have an idea that what is the normal level of activity, and then you segregate the fixed and variable cost and compute the variable cost per unit, right. And at the end of the period, ascertain the actual activity, compute the variable cost allowed for this level and fixed cost to give the budget a cost allowance, right. So, allowed cost is equal to fixed cost plus actual units of activity for the period into variable cost per activity. So, this will be your total cost, right? There is another method which is called multi-activity method, right? So, under the formula method or ratio method, what we do, we see that what is the normal level of activity and what are the variable costs, what are the semi-variable costs, what are the fixed costs, right? We keep the fixed cost same at a given production range. We change the variable cost proportionately, and semi-variable cost we find out that how much is the fixed element and how much is the variable element in that, and depending on that then we change the variable element proportionately and keep the fixed element fixed. We will do a problem later on this topic. Okay, right.